I think as we get used to the virtual world, you're not getting the feedback from having a room fill up and chairs being filled to give you the cue. Okay, so I think we're starting to get a good mass here. So we have a lot to talk about, and I know that these women are not shy about speaking, so I want to make sure that they all get the proper time and for us to get through what we think is a pretty informative and cool program. So I guess let's just kick things off and get started. Welcome everyone to those who logged in and are able to join us today. For those who don't know me, I am Kathy Yoon, and I'll be moderating today's discussion. I am special counsel at the law firm of Katten, Wuch and Roseman, where I am lucky enough to be able to focus on supporting the blockchain and crypto ecosystem. So just to, I guess, kind of give a little background as to why we're doing this right now. I think it's not surprising that we're hearing a lot about cryptocurrency recently. It seems like it's starting to become a little more mainstream in the fact that, you know, we even have Bitcoin referenced in mainstream media hits like Showtime's Billions, for those who are fans of that. So while crypto may be becoming more mainstream, from a media perspective, does that necessarily mean that it necessarily translates into institutional investors embracing transacting with crypto? There's some reports that indicate that there is a rise, but I don't think anything beats firsthand knowledge and reporting. So today's panel will bring that firsthand knowledge and experience on engagement by institutional investors in the crypto space, how they're getting comfortable in the space. And, you know, we're going to talk about some of the risks, obstacles, and concerns people face as they kind of engage. So ideally, as you know, I've said before, we'd be doing this presentation live, but we're in, you know, the virtual age right now, especially in these times. So while we would love to have this be much more interactive, we're a little bit limited. So what we're going to do is we're going to try to get engagement and feedback from the audience and we're going to base this discussion on a series of poll questions to get a sense of who you are as an audience and to kick off our discussion points. Additionally, there is a Q&A function. So if you have questions that come up throughout the presentation, feel free to ask. We'll try to check them periodically and try to answer them from time to time. So now that we have kind of the setup here out of the way, I want to move over to the VIPs of this presentation. It's definitely not me here. So why don't we kick it up? I'm going to ask all the panelists to introduce themselves. So let's start with Mary Beth.
Thank you so much, Kathy, for having us, and thank you all who are here joining us virtually. We thank you for being here. I've had a pretty diverse career and done a number of things before getting to the crypto space. First, I spent, over 2 decades with the U.S. Justice Department, most recently serving as United States Attorney in Western Pennsylvania. And I did a brief stint as reputational officer at the United Nations, and then began working in the blockchain space when I was a partner at the international law firm Bryan Cave Leighton Paisner, and represented a number of exchanges and other participants in the space. Then went on to become general counsel at Kraken, and now I am chief legal officer at Bitstamp. So I oversee all of our legal teams globally and some of our compliance functions, and serve as a member of our executive team.
Great, Demelza.
Wonderful. Thank you, Katten and Kathy, for having me here. So basically, I worked on one of the first 3 crypto funds that were launched in Europe under the AIF and UCITS legislation. So basically, that means that we had our crypto assets held by a custodian bank, Bank Frick, and we were regulated securities. And this regulation was done through Liechtenstein. And we launched the fund in 2018. And I was working on that for a couple years, trying to get regulators and custodian banks on board because it's very unique because the assets are held by a custodian bank and they are basically liable if the assets go missing. And that took a long time to get regulators on board with. I moved on from that position and I'm now managing the Dash Investment Foundation, which is a Cayman-based foundation. It's memberless, it's ownerless, and it invests in blockchain startups. And it's the capital for that foundation comes directly from the Dash protocol through their inflation rate. And I'm also doing my doctoral thesis with Andrei Karolinko, who is the former chief economist of the Commodities Futures Trading Commission, and he's currently based in Cambridge. So that's a kind of academic and practitioner role. I have one foot in each. That's me.
Thanks, Demelza. Karen.
Hi. So I've been in software for over 20 years, worked primarily on data. So everything around data, cleaning data up, moving data, and analyzing data. And in that time, spent most of my efforts with financial companies, banks, and insurance companies. And so as part of that, worked with standards bodies like SWIFT, NACHA, and Accord. And it was when I understood the blockchain that I realized this was a enormous disruption. So instead of having to move data around, we could share this data. And then I became a miner and realized that blockchain actually works. And you can actually do transactions, and it was very liberating from that perspective. Then I started Blockchain Intel, which we'll talk about a little bit later in terms of how it's relevant. And that was really because we wanted to ensure and enable trust in blockchains. And I also started Blockchain by Women to increase diversity and encourage discussions like this on specific blockchain topics.
Thank you. And last but not least, B.
Thanks, Kathy. So I'm B. I am the co-founder and COO of Reciprocity Trading. Reciprocity is a boutique OTC desk for high net worth individuals and corporate entities who are looking to trade crypto to fiat. Prior to founding Reciprocity, my co-founder Yin and I worked at Circle on the trading desk. Before that, I was at ItBit and since about 2015. And then before that, I spent most of my career in traditional Wall Street firms on different trading desks.
Awesome. So I think with that, let's get started. And this is the first time that I'm doing a presentation with this whole poll thing. So we're going to give it a try. So thank you for your patience. I think the first poll question has come up on the side for those of you who are logged into WebEx. For those who are just joining by phone, I will read the questions out. Unfortunately, we won't be able to capture your answers, but you now know who we are. We want to get a sense of who you are. So question number one is, you are A, an experienced crypto trader, B, a new entrant to crypto trading space, C, thinking of entering the crypto trading space, or D, you're just here to learn. So we're just going to keep this up for a few more seconds. And so if people could just put in their answers, and we will hopefully get some interesting answers. It's always nice to know who we're talking to. And I think it will give a good sense of who your fellow attendees are as well. Okay, so it looks like the poll has ended. Let's see if we can get the results. Wow, okay. So for the people who are dialed in and can't see the results, 40% of you are here just to learn, which is actually great because I think we geared this presentation for people who were curious, who are not yet in the space and wanted to understand. The next largest population here is 23%. You are an experienced crypto trader. So I think it's kind of nice to have things on both ends of the spectrum. And then 17% are new entrants and 3% of you are thinking of enter. So I mean, for me, I think that's interesting. Panelists, are you guys surprised by this makeup?
I'm surprised that we've got so many people who are just, we have many who have been probably in the space for a while, but this is a big space. We want everyone to put their toe in and try it out. So this is wonderful.
And this lines up with some of the experiences we've had at prior meetings, and where we, as a company, Blockchain Intel, have tried to provide a risk score so people understand if they're just coming in, what exchanges make sense or what trading desks make sense for you, as a retail investor or as a institutional investor, and understanding the different aspects you need to look at in terms of risk.
Yeah, I mean, the one question that we haven't really asked, and we don't plan on asking, is, if people are here curious for their institutions, or if they're here just more for themselves. But just in general, from your experiences and what you're seeing from people who are onboarding, Mary Beth, from your perspective on exchanges in general, and B, from your experience on desks. I mean, what in your view is the trend for more financial institutions to start getting into this space? I mean, is it flat or is it growing? What's going on?
I would say that over the last year, it has definitely been growing. We have, and I say we have, now I've been here for 2 months. I have talked to the team. So from my past experience at another exchange and now with Bitstamp, we've had a mix of institutional and individual retail traders. But what my team tells me, we have seen a large increase over the last year with more institutional traders and moving into the traditional financial space. And I think there's probably a couple of reasons for that. More and more people are learning about cryptocurrency, and the thought that there was no regulation at all, I think, is now becoming apparent to people that there is regulation. And so for that purpose, people who may have been a little unsure about the space are starting to feel, I think, more and more comfortable with it because it is mainstream today.
B, are you seeing the same thing?
I think for us, we're coming at it from a slightly different vantage point. So I would hesitate to say we're seeing institutions as much as we see corporate entities. So there certainly have been, so I've been in sort of the trading Bitcoin world since 2015. And it feels like this year there have been like new companies that I hadn't come across before. There's certainly, because we skew more towards the boutique end of things and the higher net worth end of things, there've certainly been a number of people who are taking their first sort of larger position in the space, and or in some kind of a coin, and they're trying to figure out okay, what's the best way for me to do that? So that's been really encouraging. As far as the traditional sort of institutional type client that we are all used to, for me, I've had a lot more conversations, but I think what I've been hearing is, to your point, Mary Beth, people are getting more comfortable with it. They understand that there are some regulations that can be followed. They know how to work with it. A lot of the people that I used to work with on trading desks and the larger banks are trading for their PAs. So they're like, okay, I get a feel for the volatility here. I kind of understand how this is acting, and they can communicate up a little bit easier, but you still kind of run into the same issues with how do you adjust to this as an asset class, right? How do you actually handle the custody stuff? To Demelza's point earlier, there's a lot of conversations that need to be had around getting risk and compliance teams comfortable with how to manage this. And then operationally, how do you do settlements? What kind of sign-offs, or who's got the keys, that kind of thing. So I think for me, we're not having those conversations at a very serious level because our size just isn't conducive to it.
Okay. So I think we just had the second poll question go up, and it was just trying to capture, people were retail, institutional. Come on, folks, we only have 8 of you responding to these questions. We need a better model here. So, so it looks like from these answers, people are skewing more towards the retail side for those who are participating or who are answering at this point. But I think it's it's interesting. It's from the Catton side, when we speak with clients who are looking to get into this space, I think it is, especially in the more traditional financial services models, it's individual traders or individuals who are exploring trading in crypto, right? And so they might do it on their own, just to kind of get a feel for it and understand it, and then they will take it to their trading desks as a way to diversify portfolios or their investments. And then it's something that the desk will take on. But there always needs, in my experience, there always needs to be that one person who tries it out first, who gets a feel for it, who kind of understands the risks. And so, but it's not necessarily always a desk or, an investment, officer who's saying, let's just go in and go full steam ahead and do it. So I don't know if that's something that you guys have seen as well.
Yeah, I think, historically, for a lot of the larger desks, that's what it was like. When you're talking, Kathy, I'm thinking of that John Oliver episode that he did on crypto, and everybody's got that guy in the office that doesn't shut up talking about Bitcoin. I think a few years ago, that's kind of how it was pushing forward, right? You had Mike Komaransky at DRW, that was one of the founders of Cumberland, that started a huge desk, right? Always kind of Colin Platt, that I used to know when he was at BNP, he was kind of the advocate internally to try to push it forward. And you do have to have that one person that's a repository of information, and that's your go-to guy to kind of get that going. I think what I've been seeing anyway in the last couple of years is that that's certainly getting some traction. And that, you saw Oppenheimer now has had 2 conferences just on crypto, and it was super encouraging to go and see who is attending. Credit Suisse, same thing, right? You go and you sit in that room and you see all these other people, and they're asking really good questions, and they're asking much more about wallets and multi-sig, and how do we think about this from a risk point of view, and how are you marking this stuff to market? So I think you're certainly seeing that progression for sure.
Right. But and hold those thoughts on wallets and integration. We're definitely going to cover that at the end, because I think those are definitely very important things, and it's you're right, it is on top of mind for a lot of people who are involved in this space. So Demelza, so we're talking about from an OTC desk and exchange perspective. How are you seeing engagement from the fund side?
Sure. So I think it depends on the region that you're in. Basically, the DACH region, which is basically Germany, Austria, Switzerland, Liechtenstein, regulatory wise, actually, there's a lot of progressive regulators that are willing to work with innovators on trying to allow this space to grow. On the other hand, investors here are quite risk averse. They're quite reserved. They're usually invested mostly in equities and bonds, the treasuries of the German government. And there's also a regulatory aspect. So for example, under the UCITS and AIF, Alternative Investment Fund directives that are European-wide, European Union-wide, and European Economic Area-wide, you can't really hold physical gold, for example, in a UCITS fund. A lot of the assets where you have physical custody, they're going to be regulated as an AIF, and those are mostly for professional and accredited or qualified investors, not really for retail. And pensions, insurance funds, large asset managers for banks, they're really heavily regulated what they can actually invest in. So a lot of them will only put 5% of their assets under management in a AIF that has a more exotic investment asset class or strategy, like real estate or convertible bonds or crypto or gold. Most of it's invested through UCITS, where you are holding on to stocks or bonds. So what I've seen is that when let's say the hierarchy of decision making is quite flat, where you have a family office, where you have a high net wealth individual, where you have a private bank or private asset manager, of what's called a Vermögensverwaltung here, then you have a lot more interest in cryptocurrencies and crypto assets. And these people are telling their private banks, we want to learn about crypto. So for example, Julius Baer, one of the larger banks here, moved into the space because they had so many of their private clients that said, we want to learn about crypto. So now that, Julius Baer's working to teach their investors about, for example, hardware, ledger and Trezor wallets to tell people how to do custody. So you have a movement into the space from the private banks. The retail banks in this region are not there yet. But the private banks, they're much more forceful on this topic. And the high net wealth individuals and the family offices are much more forceful. That's been my experience.
I mean, I think that, and are you speaking mostly from what you're seeing in Europe?
Completely. I've only managed funds in Europe and had investors subscribe from Europe. None of the products that we have can be sold to Americans.
Right, and I think that's one of the things, right? We there are a lot of funds who are starting to look into the space, who want to diversify their portfolios, and then they'll come and talk to us. And then we'll say, well, you guys will need to revise your PPMs. You don't have this as part of your, investment mandate here. And they're like, really? and it's just one of those things where I think as more, funds will start to look into the space, they will start thinking about maybe dropping their PPMs a little bit differently to allow for investments in this space. Your point in terms of the private banking side is really interesting. I have a lot of friends in the private wealth space, and they, we go out for, it's great. They want to take me out for drinks all the time because they want to learn more about crypto and blockchain, because they have a lot of their clients asking them about it, but their institutions will not allow them to invest a portion of their portfolio in this space. So I think they're hoping and expecting that will eventually change, but in the meantime, they're trying to learn as much as possible, and I get drinks out of it. So it's a win-win for everyone. Okay, it looks like the next poll question had gone up. Basically, we want to get an idea of what people invest in. So the choices are A, Bitcoin only, B, altcoins, and so we're talking ETH, EOS, Ripple, to name a few. C, Bitcoin and altcoins, so a mixture, and then D, none of the above. So I'm not surprised to see that 13% said none of the above, because if people are here to learn about the space, they might not necessarily be investing in it yet. But I'm surprised because I thought there would be more people doing the Bitcoin only investing. But it looks like people are investing both in Bitcoin and altcoins. So for me, that's a little bit surprising, but I don't. What about you guys?
Yeah, no, that's in line with what we see, because we support software for multiple coins, and we're just seeing people move out from Bitcoin into other coins to diversify. And they want to know the risk associated with those altcoins too.
So B, from your perspective on a trading desk, how do you determine which digital assets to trade?
Great question. So there's like three main categories that we look at. Number one would be more on the regulatory side. So because we are purely an OTC desk, we view everyone as counterparties. So we only trade in coins that are most like a foreign exchange or an FX spot transaction. So we look for coins that have those characteristics, number one. Number two, relatively basically, is there demand? Like, are people asking us to trade this? Are we seeing people coming in asking for quotes? Is this something that we think we can actually add value and add to the liquidity? And then that leads to number three, which is there liquidity, right? Where do we source this? So our trading desk is a principal trading desk. So we're committing our own capital. So we need to make sure that we can manage the risk. So when we're evaluating a new coin as to whether we're going to trade it, it's like, okay, where can we source this, right? What exchanges can we find it on, and can we trade on those exchanges? Number one. Then number two, do we have any alternate sources for these coins? So a lot of times we've got direct connections to the projects themselves, and we can use their treasuries and their foundations as a secondary kind of route of liquidity, so that we know we can manage it. Those are sort of the three big things. So do we consider it more like a currency? Is there a demand for it? And number three, like, where's the liquidity and can we source it?
Okay, thanks. And then I guess Mary Beth, I mean, obviously you're not going to be able to speak on behalf of all exchanges, but from your experience, like how do you work with the team to have, what is the criteria for assets to be listed on the exchange? Is it along the same lines B was talking about? I mean, I'm sure there.
Sure. I mean, I think that it's probably 90% is Bitcoin that for interest. So I don't know if any of you have a different perspective on that. So there's a huge difference, I think, between those customers that want to trade Bitcoin and those that want to trade other coins. Now, certainly, while Bitcoin is definitely the big dog here, we are interested in lots of other projects, and we want to, make those coins available to our customers who are interested in them. So first, we would look to see, do we think that our client base would be interested in this new type of coin? Our development teams would look at it to make sure that it is technically sound, and that we would have the ability to host this on our platform, and that it would not cause any security risks to do so. We would definitely want to make sure that there's liquidity in the market. And then we would look at all of the places where we're operating and whether this particular type of coin that we're considering is appropriate in those jurisdictions. And we might have to offer it only in certain places and not others, but we would conduct a rigorous analysis under the regulatory laws of the various jurisdictions around the world that we operate in, and decide whether we can offer it, we should offer it, and whether there would be an interest.
Okay, so Karen, I guess from a risk reporting compliance perspective, we kind of listened to what B and Mary Beth spoke about from a trading desk perspective and exchanges. Let's take privacy coins, for instance, right? I mean, there's some issues, and I think when people hear privacy coins, they're either put off or they think it's the greatest thing ever. But from an exchange perspective, what are certain things that exchanges can do to list privacy coins, but to manage and mitigate potential risks associated with that?
Yeah, sure. So to just give a little background on privacy coins, there's Zcash, Dash, Nero, and others. And the reality is that these privacy coins are only used in this private mode a small percentage of the time. So Zcash, for example, is only used 15% of the time in this private mode. Dash is only used less than 2% of the time in this private mode. And that's an important understanding, because that's what we talk to regulators about. So as a software company, regulators want to understand what our software capabilities are in terms of being able to identify, source, information about these private transactions. Now, in reality, what we've heard from regulators is they want to just understand what private coin or privacy coin activity is. For example, one regulator that we talked to wants to know if a customer is unwilling or unable to provide information about the coins, the source of the privacy coins. Now, what we do in software like ours does is provide that information. Which coins are private? Which transactions have been sent in this private mode, and what percentage of the transaction value has been sent in this private mode. So if you have, for example, a customer who just wants to make some of their transactions private, but not the majority, then it may not be that big of a deal. But if you do have a customer that has the majority of their coins in some kind of private coin and sending the majority of the transactions in this private mode, that might be something to investigate and look into further. But that's something that software like ours can provide information on, as well as the private coins or the private transactions that are related to crime. And so that's something we work with the FBI and other law enforcement around the world on, is tracking which transactions specifically for which coins actually have been involved in illegal activity. And that way, exchanges and trading desks can mitigate their risk and understand not only what's the exposure to them, but what they need to report on to regulators.
Okay, great. I think we're going to go a little bit more in depth in terms of what safeguards and what people can do first identify the risks and concerns associated with trading in crypto. And then I think we can kind of go through what some of those mitigating factors are going to be. So the next poll question just it went live, and now we have the responses. But for those who are on the phone and can't see the question, still trying to figure out who the audience is. So you, A, trade on exchanges only, B, trade through OTC desks only, C, trade through a combination of both, D, are trying to figure out how to get started. So not surprising based on the first question, about 3/4 of the audience here are trying to figure out how to get started. So I think that's hopefully we're going to give them good information at this point. And then the next largest group, 18%, they trade on exchanges only, and only 2% trade through OTC desks only, with 4% through a combination. So I think it's at this point, I'm wondering if we kind of do, maybe since we're dealing with people who are trying to learn in this space, Demelza, do you want to talk about the different sources of liquidity? So, I mean, if people are trying to learn, let's kind of dig down a little and what are the options that are out there?
Sure. Well, if I was new to this space and trying to get involved, I think that I would make an account on an exchange. And the idea with an exchange is that you can usually see what's called the order book. And this is going to be the entire amount of people selling that coin and the entire amount of people buying that coin. And you can see basically what's called the bid-ask spread. And you can basically buy in at a price where other traders, other people in the market are willing to sell crypto to you. So there's different types of liquidity in the market. And a beginner, for me, I would generally think an exchange is the place to begin. I don't work for Bitstamp, so Mary Beth can talk about exchanges later. But once you evolve past exchanges and you are doing large trades where you want to minimize things like slippage, then you would move into kind of B's area where you're working with an OTC desk. And there's different risks. There's different what is called counterparties, which is basically who has access to your capital and for how long they have access. And there's risks and there's benefits and there's a lot of players in the space. If anybody wants to take a really deep dive on this, there's a great paper written for amateurs, beginners, completely beginners. This is called Betting Blockchain Will Change Everything, SEC and CFT Regulation of Blockchain Technology by Richard Levine, Peter Waltz, and Holly LeCount. This describes what is a security, what is a securities exchange, what is a broker-dealer, what is a transfer agent, what is a depository. And in very plain terms, so a person like me who's not a legal person can understand this. But generally, the difference is let's say, for example, that you want to buy Bitcoin. Now, you call me up and you say, Demelza, I want to buy Bitcoin. And I come to you and I say, okay, I will buy that. I will sell you Bitcoin and I will take your fiat at this price. And let's say that I take that risk onto my personal bank account. So I'm actually putting my risk, my capital at risk. Okay, so this is basically called a principal broker, where the broker is putting their own capital at risk. That's one option. Another option is where, let's say that I, as a broker, turn around and say, you know what, I'll take your buy order for Bitcoin, and I'll turn around and I'll call up my friend B, and I will try to execute that trade through B. And then I'm not putting my own risk and my own capital at risk. I'm only an intermediary at that point between you and B, and I'm charging my fee, right, to introduce you to B, kind of. Then I'm basically an agency model, okay, where I'm basically just I'm not putting, maybe for a small amount of time I have some risk on my books, but I'm mostly just trying to match different parties in this space together. Then there's the other option, which is like an exchange where you're really trading against people directly on the exchange. So these are kind of the different options that I've seen. And maybe I'm sure the other women who work in these specific fields can talk about the fees and the risks.
Yeah, I mean, I think that's the other thing, just really quickly, and I'm just watching the clock as well. But I think what there, and then there's a financial cost too, right? I mean, we're talking about spreads and fees, like the cost of doing business on either a desk or an exchange. I think I mean, I think it definitely varies, and it's going to depend on the size of the transaction, what exchange you're going to. But I think that's just something else to consider, when you're trying to figure out what type of transaction you're looking into. If you're going to do one on an exchange, you're going to look at the fees associated with your trade, and then for the spreads going through desks, I think it will definitely depend on volume there as well. Let's go on to the next question. So if you engage in crypto trading on exchanges, A, you only trade on regulated exchanges. B, you only trade on non-regulated exchanges. C, you trade on both regulated and non-regulated. And D, you're unsure of the difference between regulated and unregulated. So hopefully we'll get the answers there right now. But while we're waiting, I think it probably makes sense, based on this audience here, to kind of do some level setting here. I think when we say exchange in the crypto space, it's not the same thing as in the traditional sense. So I don't know, Mary Beth, do you want to tackle how crypto exchanges may be different from more traditional ones?
Sure. I would say generally, and obviously I'm not speaking about every single exchange, but generally the way exchanges work is that they have buyers and sellers together on the platform, and the exchange is a matching engine which puts buyers and sellers together. And as Demilza said, you can look at an order book and you can see what, price people are buying at, what are they selling at. You can also look at the trading sort of value of the particular asset over the past hour, day, month, year, and you can see how the prices have fluctuated. So I think that that's probably one of the things that people are most afraid of with regard to cryptocurrency, is they don't know what the value is. What is it worth? And what is it worth today? What is it worth tomorrow? And by looking at the sort of history on the exchange, you can see how that value has fluctuated. So yes, exchanges in the cryptocurrency space are slightly different than in the traditional financial markets, but they primarily want to offer a fair and transparent market for buyers and sellers to come together and exchange digital assets for digital assets, or digital assets against certain fiat currencies.
Okay, while I have you on the spot here, what is the different? Can you give an overview of the difference between, why would one in the crypto space, why would one be considered a regulated exchange versus an unregulated exchange?
Well, all over the world, there are different levels of regulation. So in some countries in the world, digital currencies are banned. So it is not legal to hold them or buy them. Fortunately, that isn't the case in most countries around the world. Certain countries have their own system of regulation. And here in the US, we have a lot of different kinds of regulation. So depending upon where you want to do business and where your clients are located, you have to make sure that, or we from an exchange need to make sure that we're familiar with them so that customers in those places, have the ability to trade with us. So I'm just going to give you some general examples of some of the things that regulators will do. Most will have a capital requirement so that the exchange must maintain a certain level of capital. And all of these requirements are for the protection of customers and for the maintaining the transparency of the market. So we have capital requirements, sometimes custody requirements, where there are specific rules for how we can hold and custody our clients' assets. Whether we have to have certain AML, BSA policies and programs in place. And that's a good thing because we need to make sure that we are protecting the users on our exchange and that we have the ability, to prevent and detect violations of the law. We also have to employ certain things like transaction reporting, maybe asset tracing through companies such as Chainalysis and others. We might also have to employ market surveillance depending on where we're operating. We have to conduct sanction screening to make sure that we are not doing business with countries or people that we shouldn't be doing business with. And there's also other requirements that are related to corporate governance and other sort of just good business conduct. And maybe overarchingly, when you are regulated, you have a partner in the regulator. And so you have a relationship with them, you agree to comply with the requirements, you agree to monitoring, and there's a lot of communication with regulators and with various regulators in different jurisdictions to make sure that we are doing the best job we can to protect our customers. And by doing that, we hope to have customers feel more comfortable that they ought to do business on our exchange or on exchanges that are regulated as opposed to non-regulated.
So really quick, and I just kind of wanted to get Karen's thoughts on certain things, but one question just came in. It's at this stage, are there any domiciles that have stricter regulations than others? And I think you alluded to that. Some jurisdictions, go as far as banning trading, but I guess without putting words in your mouth.
Well, there are certain jurisdictions like Japan, for example, that requires that you would keep assets of Japanese customers in segregated wallets from customers from other countries. So that's just one example. So every regulator has their own sort of specific things that may not be found in others, but the list that I shared, those tend to be the common things that most regulators are looking for when they license an exchange and agree to supervise it.
So, all the things that you had mentioned, all of the regulatory reporting, the monitoring, these sound expensive. So I feel like when you're dealing with a regulated exchange, because you have higher expenses, the fees might be a little bit higher. But Karen, let's just kind of talk about it from, so maybe if you're kind of looking at from that perspective, an unregulated exchange, and just other things that could be more expensive. But from an investor's perspective, what's the value proposition of going to a regulated exchange versus an unregulated?
Right. So there's two areas I'd say. First is regulatory, and the second is liquidity. So going back to what Mary Beth was saying, it's important that an exchange has some kind of transaction monitoring going on so that they can catch if there's illegal activity or money laundering. And that's because, quite frankly, if they don't, they'll get shut down. And so there have been a number of exchanges that recently have been shut down because they've been involved in some kind of money laundering, activity. Now, the second is liquidity risk, and that is going back to again, what Mary Beth was talking about, and also what B was talking about before. What are the sources of liquidity? Do these exchanges have the order book depth to handle a crisis? Like we have a number of withdrawals that go through, and if those withdrawals, are significant, the market could change very rapidly. And so, do those exchanges not only have the order book depth, but do they have the processes in place to process transactions quickly? So then you want to understand, in terms of liquidity risk, what's the settlement time? Because if you are a trader, the market changes very quickly, and you're the last to get your funds out, you've just lost a whole bunch of money. So you really want to understand um, those two aspects. First, the regulatory risk and the liquidity risk as an investor.
Okay, thank you. And I think that all segues well into our last poll question. So basically, I mean, and then I think this kind of goes into both people who are already involved in the space and those who are thinking about entering into the space. What are your primary concerns with respect to investing in crypto? Is your primary concern liquidity? B, regulatory reporting. C, security of crypto, so custody of your assets. D, are you scared are you concerned with getting into the space because of reputational risk? Or is it something that we haven't discussed here? So while we're waiting for those results, I think let's talk about custody. I mean, unfortunately, it's a hot topic. A lot of people talk about it. Don't want to go into and I especially on the U.S. side with the SEC and custody and all of that. But let's just talk about real world. You are engaged in the space, or you're looking to trade. What are choices for custody? What's being done today? And what are different custodial models? And if you were looking to get involved, how would you set it up from let's do it from a corporate perspective, since we're talking about institutional investors. Start with, on an exchange side, what are the different choices for custodial models?
Well, from an exchange side, there are many exchanges that, custody their own crypto assets. And in that case, generally, they will have some type of model where they hold, a very high level of assets in what is called cold storage, which is held in a, I'm going to just oversimplify this, but a computer that doesn't touch the internet. And then only a certain segment of the cryptocurrency is, moving around in the, medium hot or hot wallet. And that's one model. For the regulated exchanges, most regulators are going to require that the exchange use a custody model where we are working with a custodian that is holding those assets for us. Other regulators will also require insurance. So in many circumstances, exchanges have to insure those assets that are being held. So the customer, I think, should understand that we have in place, and when I say we, I'm speaking of Bitstamp, security functions, so that we are securing our exchange, that we are working with qualified custodians to hold the customer's assets, and that our primary concern is to maintain a transparent marketplace, and to do this as safely as we can for all of our customers.
From your perspective, like what are some best practices in setting up wallets when you're engaged in these types of trades, knowing that things move fast? You might not necessarily, want to spend the time to get something that is completely not connected and that's offline. Like pricing, in this space moves pretty quickly, but how do you make sure that you capture, pricing, competitive pricing, but also do it in a way that you're protecting your assets?
Right. So speaking from our perspective, specifically as a trading desk, one of the biggest friction points in the model is what Mary Beth kind of touched on with like the whole hot, warm, and cold storage issues. So the friction point that I'm specifically referring to is like we're trading on multiple exchanges. We have some capital on each exchange. If we're going to execute on one, we've got to pull from the other and redeploy the capital there. And that can be particularly onerous, right? So because you've got withdrawal limits, you've got fees, you've got all kinds of things you need to take into account. So for us, from a trading desk perspective, it's very important that we have quick access to our coins and our capital and that we're able to move it around. From our counterparty's perspective, on the other hand, it's a question that I'm asked regularly. We're agnostic, so our model is fundamentally different to the way Mary Beth and most exchanges described. We don't offer any custody solutions. We don't have an account-based structure. It's very clean transaction. So if Karen was doing a trade with us, like we agree a price, she's got her own wallet, she sends her coins to me, I deposit the fiat in her account. So it completely depends on her business model, why she's executing her investment thesis, right? If she's going to be trading a lot, she's going to want something that's more liquid, like exchange accounts, a hardware wallet, maybe a Ledger or Trezor that Demelza had referred to earlier. If you're a larger institution, like you're going to look at more like a Fidelity or a BitGo or something like that, where you're going to keep a chunk, and you're like a long only fund, you're going to keep a chunk of your portfolio in cold because it's more secure and you've got comfort from a risk and compliance standpoint. If you're actively trading it, you're going to keep a portion in sort of a warm or hot wallet so that you can move it around. So it's just very important that you know yourself and you know what's my goal, what's my objective, and what do I need? And then you explore the custody solutions under that. I mean, it could very well be the case that it's like you've got a multi-provider situation. And then, you've also got MPC solutions like Curve and Fireblocks and Unbound that like offer a whole other sort of host of applications and practical considerations from a trading perspective. So yeah, my number one thought on this is just like, know your role in the ecosystem and figure out what is going to work the best for you among all the solutions that are out there.
So does something like whitelisting wallets, that's something that's very important, first of all, and I think I'm going to let Karen describe what whitelisting is. But if you are whitelisting wallets, would that also add to facilitating faster trades, or what are the benefits of whitelisting?
So simply for us, the benefits and why we whitelist all of our counterparties' wallet addresses is to prevent theft and fraud. So essentially, I know like from an exchange point of view, a lot of exchanges do it as well, but like if someone steals your identity or happens to hack into your login or whatever and tries to execute a trade, and then they say, okay, send the coins to this wallet. If this is a wallet we've never heard of, like we're going to run it through a transaction monitoring system similar to like Blockchain Intel, Elliptic, Chainalysis, one of those. Two, we're going to insist on some sort of a video confirmation with someone we know who's an officer at that entity or the human that we're dealing with and say, hey, did you actually change the wallet address? We don't have this on file. Like, I need you to send me something from an existing email that we haven't corresponded on. Like, there are definitely things in place, but the number one reason for us is to prevent theft and fraud.
So Karen, from your experience, and this is something that you guys do. How does it work? How do you do it? How do you actually do it in 2 seconds?
Yeah, so a couple of things. One is absolutely to prevent fraud. We've seen a lot of impersonation fraud of different types, and so that's where we do work with law enforcement and do all the tracing to make sure we understand when some kind of fraud has occurred, how it's occurred, and the path, and we verify that information with law enforcement. Now, in terms of whitelisting and sort of, I'd say, risk scoring more broadly, what we do is provide indicators of all the exchanges and all the related addresses that are known with those exchanges. So you can see, okay, is it Coinbase we're dealing with, or is it a lesser known exchange? And is that lesser known exchange one that has been hacked into? or one that has had liquidity issues, meaning we've found a difference between what they report as their transactional volume and what their actual on-chain transactional volume is. So we'll provide indicators basically showing just which entities and along a whole host of different criteria of regulatory, liquidity, and other types of risk. And so this, oh, sorry, just real quick. And this help, basically in terms of whitelisting, distinguish between the ones that are, ones you have to watch out for versus ones that are ones that you can trust. And that's because we have a risk score that's associated with each one of these exchanges and entities on a scale of 1 to 10 that helps you to delineate.
So not surprisingly from the poll results, security of crypto was the biggest concern. And I think and I see that we have 2 minutes left and I want to keep us on time here. And I think from this brief overview that we've been able to do today is that, it is the biggest concern. But going back to what B said, you should understand your role, how you want to do things, what you want to do, what you want to get out from it. Because that's if you're all over the place, you're definitely going to run into more risks, or open yourself up to more of them. I think just having good policies and procedures in place, based on knowing what your role is, going back to what Mary Beth was saying, all the things exchanges are doing in order to make sure that their marketplace is a safe place for people to go to, protecting both the platform and the investors, the buyers and sellers on it. So I think it's helpful to know, and it's comforting to know that people do understand that these are risks, they're these concerns, and they're actively going out and trying to address them and mitigate them, and to allow for the space to grow. So I didn't mean to have the last word. If anyone else wanted to say something really quickly, I'm upset that we didn't have more time for questions and answers, but we will definitely circulate our contact information following this. So if people have any follow-up questions, please feel free to reach out to us. And before I end it, anyone?
Yeah, one just quick thing to add on to what you said, Kathy. There's a kind of decentralization spectrum, if you could call it that. But basically, it's adding to what B said. I mean, it's understanding your role, but understanding your risk appetite and how you want to manage things. Do you want to manage it entirely yourself and be your own bank? That's one end. Or do you want to give that up entirely to somebody else? And it also has to do, and that's, I would say, very similar to how we address, do we use cash? Do we use credit card? Do we use some other form of payment? It's just a spectrum of choice that you have, which is something we didn't have before, which is what digital currencies really enable us to do.
I think that's the perfect way to end it. I think I can speak for everyone. We're all open to continue the dialogue and answer any questions. So we do hope to hear from you, and hopefully we'll be able to do more of these presentations to continue educating you. Thank you, everyone, for joining us.
You.
Thank you.
Bye.